Markets are making history. The first quarter of 2024 just wrapped up, and to say it was anything less than special would be selling it short. And one thing you don't want to do in this market is sell stock short. So in today's video, we're going to be talking about the long trade and how much gas is left in the tank. We're also going to be looking at the latest charts. The March monthly candle just closed for all the major indices, and we're going to be talking about where we're going next and key levels that we could possibly pull back to. We're also going to be talking about the equal weight. Historically, it's trading at 13% above fair value, and I'll show you what this means for future returns. We're also going to be talking about April's most likely outcomes, the quarter just passed, as well as inflation ahead of PCE. Will we continue to see disinflation, or is stagflation on the horizon? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. What a way to end the quarter. Really green across the board, but definitely some clear signs of rotation as well as rebalancing, window dressing in these portfolios. Look at specialty industrials, right? These guys have absolutely outperformed this month, this quarter. You know, they were really red today. And then we had stuff like financials, energy, real estate, utilities, really green at the expense of this, at the expense of the bigger tech names, right? So definitely some rebalancing going on, definitely some window dressing going on, but a green day across the board, particularly in the equal weight. The big guys did weigh on the market cap weighted index as a whole, but all in all, you know, a very good month, a very good day, a very good quarter. Looking at sectors, the best performing sector was GDX, actually up 23% for the month. Just so you guys know, GDX was my number one sector pick for the month of March. It returned 23%, absolutely crazy. And we're going to get into my monthly performance, my quarter to date performance in the weekend video, and what I expect to do really well in the next quarter, in the month of April as well. Go ahead, subscribe below so you don't miss that. We're going to talk about my expectations, and I'm even going to show you guys some of my models that I use, which have been very accurate up until this point. But I digress. On the day, GDX, metals mining, home construction, XLE, best performing sectors, right? Look at everything that didn't beat the SPY. IGV, XLC, XLK, discretionary. Now, these were actually just slightly red, nothing to write home about. You know, the bears can't really get excited about that. But yesterday, the same stocks, apart from semiconductors, right, we're in this section right here, underperforming the SPY. So there's definitely broadening out going, definitely rebalancing happening in this market right now. But all in all, as we approach these highs, we're seeing breadth expand, which is really good. That's how you know we're in a very strong rally in this market, and this is really what you want to see at highs. When you see breadth expanding at highs, that's how you know it's going to continue. And sure, we can have pullbacks 100%, but normally what happens is when we get to highs, breadth deteriorates. That is not happening. Breadth is actually expanding across sectors and size at the moment, particularly in small caps. Now, let's actually have a look at the quarter performance, guys, and the monthly performance. The best performing sector, comm services, up 15.6% for the year to date. Now, this is Q1 24, crazy. In close second, energy 12.7%. Kind of nuts when you think about that. Information technology, now, semiconductors not on this list. They were up 27% for the quarter. They're part of technology, and you know, a big part of that 12.5% has to do with semiconductors, and also a large part of the underperformance we're seeing has to do with Apple. And the same is true here for discretionary with Tesla, and then staples as a whole, even up 6.8%, considering that it is a very risk-on environment. And that just goes to show that when things are bullish, a rising tide lifts all boats. But all in all, very good across the board. The S&P 500 up 10.2%. Cyclical sectors outperforming the S&P 500. And then we have sort of like defensives underperforming. But still, you know, you look at a quarter portfolio gain of 8.4%, right? 8.4% here in healthcare. And you take those any day of the week. That's a great quarter performance, like, especially considering it's only 3 months of the year. You take those gains and you run with it. Now, breaking down indexes, Russell 1000 growth remains undefeated year to date, up 11.3%, but the best performing sector month to date is Russell 1000 value. So sort of like large cap value. And this is normally what we see. We see large caps lead and then small caps follow. So we'll see Russell 1000 value perform really, really well. And then we'll see Russell 2000 value follow. And you can see it has followed, but we should see continued follow through in small cap value. And that's normally how the indexes go. The big guys perform, then the small guys outperform, both in value, both in growth, both in sector and size. In all things, you normally see the leaders lead and then the smaller guys follow. Now, the S&P 500 up 10.2%, 3.1% year in March, outperforming the nasdaq, although this is not the nasdaq 100. And you can definitely see that for the most part, growth outperformed value as a whole, to be expected, except when it came to size. Large size as a whole did outperform for the most part, but all in all, growth did outperform value on a relative size basis. But let's actually hop on the charts, the S&P 500, and have a look at everything. Now guys, before we hop into the S&P 500, let's have a look at the indexes. So up 0.11% here for the SPX, the NASDAQ 100 down 0.14%. And that's why, because we had Microsoft, Apple down for the day. The RSP up 0.35%, and the same is true for mid caps, small caps. They were all up about half a percentage point. IWM actually green here in after hours and up 0.3% for the day. Bonds didn't do much, which means yields didn't do much. And it seems like, all the focus on the 10-year is now just removed, especially as rate cut expectations have declined. Now, what we saw here today that was very interesting, Bitcoin up 2%, gold up 2%, crude oil up 2.24%. So a big commodity trade really helping energy and gold miners today, as well as crypto bros. They just love to see their Bitcoin go up. Now, let's look at the S&P 500. The monthly candles have officially closed, guys. So we're going to cover the S&P 500 today, and then the S&P 400 and S&P 600 in tomorrow's video or the weekend video. Now, let's actually have a look at the S&P 500 really, really quickly. Looking at breadth, the advanced decline line, we've made a new all-time closing high on the daily, monthly, and weekly here in the S&P 500. At the same time, the advanced decline line has made a new all-time high. That's exactly what you want to see. Now, let's hop on the monthly chart. Looking at candle structure and location here in the S&P 500, it's a green bullish candle, very minimal wick down below, which means minimal price discovery at the lows of the month, and pretty much closing at the top. There's a tiny bit of wick at the top, doesn't really matter, inconsequential, because it's a new all-time high monthly close. You can see the trend, higher low, higher low, higher low, new all-time high. At the same time, put a high right here, a higher high, and now an all-time high. Very, very bullish. So if we are to pull back, what levels should we look to? Now, ultimately, I would say we should look to this level right here, 41.89, simply because it was the low right here. But if we actually go and measure it out, it wouldn't be a great place to pull back to, because it'd be more than 20%. That would actually be bear market territory. And I think the market would freak out a little bit there. That's why I believe if we are to pull back here on the monthly chart, I think the best place we can look to is this level right here, because we used it as resistance right here, and then it turned to support here in December, and it has caused the rally after we broke above this high ever since. So this is the level where we can really pull to and see major confluence. Now, I would actually make it more specific and call it the 45.50, which would actually be the low of that month there in December. So 45.50 is the monthly pullback region we could look to if the market is to pull back. I'm not going to say we are, I'm just saying if we do pull back to that level, we would still be in a technical uptrend, and that would be a major buy zone right here at 45.50. Do I think that's going to happen? It might, but I do think that the odds are more likely that we do, have a very small wick here at the start of the month and then just continue the rally up to 5,300, 5,350 in the month of April. Now, that being said, these are the pullback regions you can look to on the monthly chart. Let's hop on the weekly chart, because we can see that the weekly candle also closed a new all-time weekly high, very similar to the monthly chart. We put in a low right here, higher low, higher low, higher low, new all-time high. At the same time, once we made this high, we made a higher high, and then new all-time high. Very, very bullish. This is just straight up, and this has to do with great macro environment, earnings, and just momentum we've seen. When you see stuff like this, right, very minimal weeks of volatility, couple of weeks of volatility right here, but inconsequential when you look at the grand scheme of things, absolutely bullish. Now, very similar to the monthly, I think we can definitely pull back, but I think all dips will likely be bought in favor to just rally like very, very quickly to the 5,300 area. That's the market we're in right now, and we're entering a new quarter. Funds are rebalancing their portfolios for the most part, and yeah, I think we're ready for the next leg up, which is going to be the leg up based on a broadening out, which is going to be the catch-up trade in the RSP, I believe. Now, let's say we are to pull back on a weekly chart. What levels can we look to and still be relatively bullish? Well, I say this level right here. Let's change that color to white, okay? So on a weekly chart, we pull back to 47.98. Let's actually just make it 4,800 flat. 4,800 flat, we pull back to this level, very okay. We can pull back here, still be in the context of an uptrend. I just favor the fact that if we are to pull back, it'll probably just be to like the weekly lows here or the weekly lows and then make new all-time highs. That's what I think is going to happen. I'm just saying if we are to get a deeper pullback to 4,800 on a weekly chart basis, we would still be very, very bullish at this level. Why? Because we saw a bit of volatility right here, the most volatility we've seen in the last 3 months, and it was also the all-time highs here in 2021. So we pull back to this region right here. That's where we should find good, strong weekly support from buyers at the 4,800 level, and just, you know, that's a pretty good zone to pull back to. It's like what, an 8% pullback, but I do favor just a continued grind up, and until we actually get a major macro event that's going to disrupt this, I think we're just going to go higher. And that macro event could be PCE tomorrow, that Powell releases. It could be. Do I think it's going to be that? I don't think so. I think next week's employment prints are going to be more important than the current PCE data right now. But let's hop on the daily chart, and what can we look to on the daily chart? So we got our levels right here. This is the monthly pullback zone where we could still be bullish. This is the weekly where we could still be bullish, right? So on a daily chart, what levels are we going to look to? Well, very, very simple. I think we just look to this level right here, you know, 5202, 5200 flat. I think that's the level you really want to look to. If we pull back all the way to here, we should find support, and that's where we should continue rally and then go ahead and make new all-time highs in the market. But yeah, 5202 is the level I'm looking at. If we do go ahead and break that, I'll update you guys in the days ahead. 5202, this market is strong. I wouldn't look to anything beyond that right now, and I will give you guys a major update if we do go ahead and break those levels. So 5202 is the level, and you know, guys, we're in, look at this. You look at this chart, bullish, okay? And we have tons of support below and not a lot of resistance above, and that means the path of least resistance is higher. Now we got the latest AA sentiment survey. Where do these members feel the stock market will be in the next 6 months? And the bulls are back. We've gone back into bullish sentiment, but to be honest, we didn't really leave last week, but maybe we were starting to see the tide turn. That is not the case. Bears tick down, neutral tick down, all of these capitulated to the bull side, and we're still sitting at very elevated levels in comparison to the historical averages, and that's what you get in bull markets. In bull markets, you get bulled up euphoric sentiment, which can take price to highs you never thought possible, and that's what we have in this market right now, and that's why we're rallying, and that's why dips keep getting bought. I got some very interesting stats for you guys. S&P 500 performance in April when the previous quarter was positive. So just the returns we can expect. This is April's performance. This is the quarter right here. As you can see, in aggregate, 1.36% average return, 23 up years, 29 down years, 32 years in total. Very, very positive stats. This is incredibly positive, especially with the average change. As you can see now, there was some very big green years and very few red years. The worst was the year 2000, negative 3.08. We know what happened in the year 2000, as well as a string of them that occurred here in 87, 86, 85, 81, but all in all, it should be a positive April. Now, do take this with a grain of salt if we adjust for market conditions, because we are in a momentum market. You can see that the average return of the momentum factor since 1980 is actually negative in April. You can see the average return is about 2.5% here in April for the momentum factor and the number of years with a positive return only equated to about 35, 36, maybe 37%. And you do have to look at the data that we are in a momentum-based market. This market has literally been rallying non-stop. Momentum is on the side of stocks, and so maybe based on this data we could possibly see a negative April. However, this data is since 1980 and you could say it's a big data set, but I would have to dive into the stats more specifically. That being said, the data I showed you previously is more accurate and more thorough, so I would take this with more weight than this. Moving on, let's actually talk a bit about the equal weight, guys, because the market is getting really pricey from a price to earnings standpoint, and there is value to be had in equal weight, but even right now the equal weight is getting a bit pricey. So this is the S&P 500 equal weight modeled versus actual, and right now we're trading at a 17 times PE. Now you look at that and say it's not super expensive, but according to this data right here, the S&P equal weight is 13% above fair value right here. So this is below fair value, this is above fair value, and you can see just here in 2013 October we were well below fair value. Now we're about the same amount above fair value. Now what does this look like from a return standpoint? Returns are typically positive but below average during periods when SPW is 10 to 20% overvalued. So this is where we are right now, 10 to 20% overvalued. You can see here that the hit rate is about 55 to 60% and the returns that we can expect is about 1 to 2%. An equal weight valuation at 17 times is looking a bit pricey. However, you are getting the 500 greatest stocks in the market. Now, this isn't necessarily a sell signal. I'm not telling you to sell your assets. I'm just providing you guys with the data and saying this is what the data has told us in the past and what it could mean for the future. Now, we also got a couple of scenarios here from Goldman Sachs and just gave us a whole bunch of scenarios based on the equal weight and the market cap weighted index and what we can expect. Now, this is currently where we are, 21 times market cap, 17 times equal weight. Now they have a couple of scenarios. So the catch-up trade is where the equal weight catches up in valuation to the market cap weighted. That will see the market cap weight move to 22 times, the equal weight to 18 times, S&P 500 at 5,800. The mega cap exceptionalism trade will see the S&P 500 at 6,000 on a 23 times market cap weight PE, 16 times equal weight PE. Then we have the baseline here, 20x, 15x for the equal weight, 5,200, and then we have our two catch down and recession risk. This is where the market cap weighted trades down in price to earnings. We should see S&P 500 at 45 times on a 15x equal weight, and then the recession risk, we have a 17 times PE, a 14x equal weight, 4,500 S&P 500, and you can see in a recession, people want to hold the bigger names, Apple, Microsoft, Google, right? Those great companies with great balance sheets, and that's why the equal weight actually moves down in valuation in such a scenario. And so just a couple of data points there from Goldman. Actually very interesting stuff when you look at it, like the different aggregate metrics. Very interesting stuff. I love this type of data. Very cool to look at and just gauge as to where the market can go, where it is right now, and where it might go. Moving on now, guys, where can we actually find value in this market? Well, we can actually just find value in value. Russell 1000 value, Russell 2000 value trades at historically cheap levels. Now the S&P 500 value, both the 1000 index and the 2000 index trade very cheap relative to growth. You can see right here at 0.5%. This is the Russell 1000 value versus growth relative valuations as of that date right there. The median is 0.72. We're sitting close to a full standard deviation below the median, and that's because the value indexes for the Russell 1000 trade at 16.4 times against the growth at 28.8, and then in the Russell 2000 it's trading at 12.7 times and the growth side 20.5. Here's the crazy situation about it. Russell 2000 value is trading at a 15% discount to its historical average. So if you are looking for discounts in the market, you may need to actually go looking at value names in each index. But if you want growth at a reasonable price, maybe go look at Russell 2000 growth companies, or maybe just buy the index at 20.5 times. Now, let's talk about the economy. This is the Small Business Optimism Index. Now, yesterday I showed you the Consumer Confidence Index. it traded sideways. Not much has changed on a month-over-month basis. We can actually see here that business optimism fell ever so slightly again here in February, and business optimism is trading at extremely low levels. We're looking at the levels even below COVID right now, and the same levels we saw here in 2008, 9, 2011, 2012. So small business optimism is in the dumps, and based on this, you wouldn't say the economy is roaring right now, but according to small business owners, they're doing it very tough out there. And I think the reason why they're doing it tough has to do with inflation. Services inflation remains higher and stickier across regions. You can see here in the US, we got very, very high services inflation compared to goods inflation, right, which is actually downright in deflation right now. And I think that's why small businesses are doing it tough. Those small businesses that are selling goods, which is what most small businesses do, I actually see are having to decrease their prices to stay competitive, whereas services inflation is actually boosting overall inflation and leading to higher wages, and that's probably eating on the margins in small businesses, because the biggest expense for small businesses, besides for actual goods, is wages. So, a higher services inflation leads to overall higher inflation. That leads to higher wage inflation, but at the same time, they're still getting priced out of the market because of competitive pressures, and goods are actually in outright deflation here in the US. And that is why small business optimism is probably in the dumps near 08, 09 levels as it is right now. So hopefully things do start to normalize both in goods and services inflation for the rest of 2024. And hopefully we do get those rate cuts, and it can help small businesses. Now, looking at the strength of the consumer, according to BOFA right here, their consumer tracker, the consumer meter holds steady in February, with the only decline we're seeing is in confidence and borrowing. We've seen a decline of -1 in this meter over the last 3 months, but that was offset by earnings, unemployment ticking up, and everything else, spending, housing, mortgages, and cost of living holding steady. Generally speaking, when we have a zero rate, it means it's holding steady. When we have an increase, that means the consumer is doing better than the month before. And when we have a decrease, it means worse. And according to BOFA right here, February 2024, November as well, and September, the consumer is holding steady, holding in there. And hopefully this translates into better small business confidence in the future. And hopefully we do get an increase like we did here in late 2023 as well. Now, looking at Gamma, a couple of things to note. Number one, we're exiting the window of weakness next week, Tuesday, and everything is now going to lead us to the April OPEX. There's a ton of positive Gamma here, a little bit of negative Gamma right there as well, but you could see a ton of positive Gamma. Now, the 5250 and 5300, this is such a dense zone of Gamma. There's so much positive Gamma, and I would say that at most until this April OPEX, we're going to see 5300. It's going to be really hard to break through this. We're going to need a lot of momentum to break through this 5300 area, just because it's so dense filled with Gamma. But anything can obviously happen in the market, but we do have to follow the system, and that's what the system says. Now, the Gamma flip is at 5165, and there is actually a quite elevated levels of negative Gamma here, but we are still in positive Gamma. We are still above the Gamma flip, and that means we buy dips, sell rips to 5300, and if it does move up, we then buy dips, sell rips to 5400. If it moves down, that's when we could start looking at bearish positions. Now, these strikes are building out, but it's not necessarily a bad thing. It gets really bad when you're below the Gamma flip zone and then the core resistance starts moving down, right, as well as the put support starts moving down the tape. That's when you want to get really, really worried. But as it is right now, we're at 5300. Everything is in this nirvana zone. We buy dips, sell rips. Retail is short puts, short calls. That leaves us in positive Gamma, and that means dealers unwind their hedges by buying, and they enter the hedges into the strength that is the market going up. It's just this perfect storm that leads to just higher price action very, very slowly until we get some form of a macro or fundamental change in the overall picture. This will continue to happen, although I don't think at the pace it has been for the last 3 months. Now, looking at market breadth, guys, and breadth is absolutely fantastic. We got short-term breadth metrics looking really, really good, as well as longer-term breadth metrics here, 200-day, 100-day moving averages on pretty much every single sector. I mean, the weakest sector you could see right here is probably like real estate. Other than that, stocks in aggregate are moving higher across the board. Having a look at year-to-date percentage of stocks positive versus negative. Look at the S&P 500, 72.5% of stocks are positive. The average change about 13.2%. versus those that are negative 27.5%, down 7%. And you know that's how it's a very, very strong market. This is very, very strong. And you could see this across the board, even in small caps, 47% positive versus 52% negative. But look at the risk to reward, 14.4% up, 12% to the downside. Now, this doesn't look the best, but you have to understand that what really matters in this market is stuff like the S&P 500, because they command 80% of the total market cap across the entire stock market. Stuff like the NASDAQ 100, the Dow Jones, these are the ones you really want to see positive, significantly positive, and a huge average change. That's what we're seeing. Breadth is really, really fantastic. Looking at the core leadership model. Now guys, we are in a strong leadership regime. What does that mean? You want to be long when we are in a strong leadership regime, and generally speaking, when we're above the zero line, you want to be long, you want to hold, and you want to sit through any volatility, because normally we go through very, very long, multi-year long rallies that are only really interrupted by macro events right here. This macro event here in 2017 was the taper tantrum. This right here was COVID. These were macro events that took us off board. This was more of a healthcare event, but such is the market. And the reason why we came undone here in 2022 was because of this COVID situation. But generally speaking, when we are in strong leadership, buy dips, hold, sit through the volatility, because higher prices normally ensue week after week, month after month, year after year. Looking at the core market model, and we are not in extreme overbought territory, we are in overbought territory. This is what you want to see in a market with strong leadership. This is not a reason to sell. This is actually a reason to be ever more so bullish. Momentum brings momentum. Now looking at percentage of stocks above the 200 moving day average, and this right here is the number of days above the 80% mark. You can see that we are slowly approaching this level right here where we have 80% of stocks in the S&P 500 above their 200 moving day average, which is a very bullish momentum indicator. You can see we are approaching this right here. And again, when we do get above the 80% level, we normally go on very, very long extended rallies that do see quite a bit of volatility. Don't get me wrong, but the second we get back in there, we go on long extended rallies that can last years. Look at this, 2012 all the way to 2020. There was hardly any interruptions, very, very minimal, and we pared those losses very, very quickly. We are entering that above 80% zone right here, and that means higher price action in the future. Now, looking at some key charts, this right here, high beta versus low volatility, moving up, that means high beta is outperforming low volatility. This is confirmation of the bull market. Same here, cyclicals versus defensives, confirmation of the bull market, cyclicals outperforming defensives. Discretionary versus staples, moving higher, that's a confirmation of the bull market, and discretionary is what you want to buy in bull markets. In bear markets, you really want to own staples. The only divergent trend we have here is the US dollar. This is the S&P 500. The US dollar is not quite following it. Now, do understand this is inverted, but we are diverging from trend. So that is a bit of a risk right there, maybe an early risk. But if we have a look at the others, we don't have confirmation of this in any of the other charts. Looking at the advanced decline line, that keeps moving up. That's confirmation of the bull market. And high yields versus treasury bonds, people are taking on risk, buying high yield, again, confirmation of the bull market. This is a risk factor, I 100% agree, but until we see this in a lot of the other charts, until we see divergence, a lot of these other charts, I would say buy dips that the market do provide to you. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video guys, and leave a comment for the algorithm. Cheers.